Okay, welcome to 3.13.1. And in this subunit, we'll be talking about primary methods of valuation of inventories. Valuation of inventory is a very important concept within the area of financial activity for business operations. And with that said, let's reiterate what that is. Valuation of inventories is actually the dollar amount of two things. It's associated with the dollar amount of items contained in all of the company's inventory. So all total inventory. I don't care what you sell, how much product is in your warehouse, for instance, ready for sale. Well, most business owners and investors who sell product and goods project it and know how much to produce, manufacture, and store. Now, there's a caveat to that. That's one area where all inventory in total is available for sale. And then that can be actually separated into the cost of items, what we call ready. Now, cost of items ready means if we took the total, say we had 500,000 products in total, okay? Dollars, that is, in total inventory. Well, let's say we wanted to divide our fiscal year up into 5 quarters. Now, is that the norm? Probably not. But with that said, it's just an easy example. That 500,000 divided up into 5, and this is not a computation formula that you need to know. I'm just using mathematics to separate the actual components of dollar amounts as it applies to valuation of inventory. So taking the total dollar amount and dividing that by 5 could essentially give you the cost of items ready to be sold. So like I said, 5 quarters, financial quarters that is, because as discussed, there is no steadfast rule to how long your financial cycle needs to be. You could have 12 quarters represented by each month of the year. But here we have 5, okay? That's $100,000 worth of product each quarter, okay? So 1 quarter would then equal $100,000 worth of product. That's the difference. The total versus the cost of items ready to go. And that's a good way to form projections on how much you may sell at a different time of the year. If you have a product that's more applicable to the summer, then maybe your second or third quarter would be more profitable than your first or last that would tie into winter. Okay, now regarding inventory valuation, we're going to include 4 different costs, okay? Now remember, we're talking about inventory, but all 4 of these components apply. Production. We need enough inventory to be produced, but we need enough production to do it, okay? Maybe most importantly, material. Depending on the type of product you sell, whether it's expensive or not, may even be irrelevant at that point as far as cost of material, but you can project how much you actually will need based on your gross profits, et cetera, from year to year. Labor, who's making your product and who's in your warehouse moving it around for you. And then you have overhead. Where are you storing your product? Right? Your inventory has to be stored somewhere. That place needs plumbing, electricity. You need rent or lease that space. That's what we're talking about. Okay. Now, as discussed, we're talking about right now in 313.1, the two primary methods to track inventory. Okay. Okay. So the first method is called the periodic. Okay. The periodic inventory method keeps track of merchandise costs in various purchases. Then it will actually compute the cost of goods sold on the income statement. So let's just remember, it keeps track of merchandise costs, right, in various purchases. Then it will compute the cost of goods sold on the income statement. Very traditional method that's used. And now we have what's called the perpetual method. Now, this covers any increases in the inventory with every purchase. Monitors every purchase in inventory. Every single purchase. Okay? However, it will lower the inventory count with every sale. So it's almost like an even more internal checks and balance regarding your inventory. Okay, it will increase your inventory account every time there's a purchase, obviously, because your profits are going up, okay? But then it'll lower the inventory count, right, with every purchase. So I bought this, hence we got a show for it. It's missing. What do? Do we replace it right away? No. We don't replace it right away in that quarter because we want to account methodically for how much inventory actually goes in and goes out, okay? And that's why we would divide it up into financial quarters the same way we would divide up inventory. And one works the same. And there you have it, 313.1.